The next story it's not a current event, but this is something that I just kind of came across while I was browsing Reddit. So one of the Redditors on Personal Finance Canada was so kind to do a kind of comparison between Wealthsimple's portfolios versus other portfolios. So, for those of you who don't know what Wealthsimple is, think of it as the Canadian version of Robinhood, except they also offer what's called managed portfolios, which is it's like a mutual fund, but it's like a robo advising service, right? Where they offer this fund that you can invest into, and because it's mostly managed by computers, sometimes advisors will kind of dictate the macro direction, but day to day is just kind of managed by a computer. And these portfolios tend to offer much lower fees than your typical mutual funds. And also, Wealthsimple is kind of like a cool new fintech company that appeals to young people. So, a lot of people who are getting into investing for the first time, just like with Robinhood in Canada, a lot of people tend to just use Wealthsimple as their first foray into the investing world. Again, if you're not super familiar with investing, you might be tempted to use one of Wealthsimple's managed portfolios. So I'm going to put up this chart, which was posted by the original poster of the Reddit post. And this chart shows the 3-year and the 5-year annualized returns of the Wealthsimple portfolios. And there's I think 3 different macro categories. You can fine tune it a little bit in the Wealthsimple platform, but there's 3 major categories, which are conservative, balanced, and growth. So they compared it to kind of the equivalent Vanguard fund, which is like passive investing. Passive just means that there's no advisor sitting there making like day-to-day decisions. It just kind of follows an index. And it compares it to RBC's mutual funds. RBC is Royal Bank of Canada. It's the largest bank in Canada. So once you compare the portfolios, there's several things to note with Wealthsimple. So one thing that this Redditor noted, and I think everybody kind of noticed, is that Wealthsimple chronically underperforms both the RBC portfolio, and it majorly underperforms at a lot of times the Vanguard funds, which are again passive funds. So yeah, basically there's 3 different macro categories. The conservative is made up of 35% equities, and the rest are bonds. And the balance is made up of 60% equities, again, with the rest being bonds. And the growth portfolio is made up of 75 to 90% equities. So this is the chart, this is the data, and this is not, my opinion. This is just fact, right? Wealthsimple has underperformed. So my question to you all for tonight is that, do you think that, what do you think is wrong with Wealthsimple, first of all, that they chronically underperform? And is there anything that they can or should do to improve? And do you find it acceptable that they offer this product if it's going to chronically underperform the market, right? Like, are people wasting their opportunity costs investing in Wealthsimple's portfolios if they can get a much better return just doing a passive fund? So, several multifaceted questions. Curious to hear what you guys think.
Alrighty, Spidey. So regarding I'll start with regarding whether or not they should be able to offer a service that is underperforming the market. I would say yes, they should be able to offer it, because of the fact that, well, it is underperforming the other fund, it is still an improvement over not investing at all, right? So yes, it's not as good as the other funds, but it still has some utility because of the fact that it's so easy to set up. It's so helpful for like noobs who are just starting out in their investing career. There's a lot of value in them just honestly getting their feet wet in something that makes a lot of sense to them. It's very easy to follow through. and they can invest in it. And yeah, it's a little bit worse, but mutual funds can be a little bit worse, and that's often where a lot of other people get their first foyer. So typically you don't get the largest returns in your first foyer into the investment market. So I think they should be able to offer this service because it still provides some utility. As to why it underperformed, it really comes down to what equities the spread is in their portfolios. Like if they have if they've selected ETFs and such that are have been underperforming, then they're going to underperform by definition because the fund is made up of those ETFs. So for example, like if there's a large percentage of the portfolio in emerging markets, and emerging markets has been not very good, then the Wealthsimple portfolio will underperform in that sector. Now, I mean, obviously the other groups are probably also having emerging markets, so theoretically similar things should be underperforming. So without knowing exactly what is in all the other options, it's difficult to say exactly what is stopping Wealthsimple from performing superior to the other ones. But it's definitely a bit surprising that they haven't managed to be. I mean, I guess they're sort of competitive-ish, at least with regards to the balanced and the Wealthsimple. The growth categories, but the conservative one, I'm surprised to see how mediocre it performed compared to the other ones. So yeah, I think it's pretty much just sometimes they pick winners, sometimes they pick losers, and it looks like the Wealthsimple bag has got a lot more losers than winners compared to the other two.
I can also mention, I guess, a few things as well. So yeah, it's kind of hard to know exactly what's in each and every one of these. I guess you want to call them ETFs. Like we don't know the specifics or whatnot. I think to give the benefit of the doubt, I guess the economy lately hasn't been the greatest, so that could be a lot of the reason as to why these aren't doing as well. Maybe it just so happens, like Tristan said, they've been picking the bad apples instead of the good apples, and then as a result, this is the case. And
so just to jump in here, the Vanguard ones are publicly traded, so you can look up exactly what's in the Vanguard ones, at least.
Oh yeah, I guess for the most part. Like speaking of Vanguard, I'll be frank with you. I think this is all a complete waste of time. You should probably just invest into an S&P 500 index fund if this is your, bag of apples, bag of like fruits. I personally like VFV, and then if you're in the American markets, you can try VOO or SPY. I think those are fantastic. I know I'm gonna give the floor for Andy and Tristan to tell you as to why VFV might not be the reason, but I subjectively think that with compound.
Actually, Dom, just to cut you off a bit, VGrow is VOOG. It's the Canadian version of VOOG. So it's actually VGrow is actually the same as VOOG, which is the growth version of VOO. So like the difference between VOO and VOOG is that VOOG has more, I think, tech stocks and has more growth oriented stocks. So like the Vanguard ones are sort of market index funds. And as I said, they're passive, right? So it is the like index funds that you
Enjoy, right? Okay.
Yeah.
Well, like at the bare bones, like I like to keep my investing strategy really simple. I just stick to VFE primarily, and then just dollar cost average and allow compound interest to, accumulate with that over time. I don't do like deep research into the other Vanguard stocks, but maybe I should. But yeah, maybe Wealthsimple needs to make better baskets of choices. I guess it's hard to say if you don't know exactly what's in it. Maybe make that whole system more efficient. And I can't remember the first question you asked before. What were the questions again? Sorry.
So I guess my question is that in paraphrased in a different way, maybe I can make it a bit more clear, is that do you think that Wealthsimple is violating their fiduciary duty? And fiduciary duty is it's like a key term used in finance where you as as a money manager have a duty to your investors or people who trust you with their money to kind of best allocate their money. So is Wealthsimple violating their fiduciary duty by, underperforming the market chronically? Should they take some responsibility for underperforming the market, or do you think that this is just, it's just maybe they had some bad luck and it's fine and whatnot?
It could be more just like the market and like the current situation. I'll be honest with you, there's a lot of other like much worse investments out there, such as like bank mutual funds or GICs. So I think as Tristan said, it's okay for them to continue to operate this program. So it seems like it's very easy for new investors to come in and then try this out. At least it's earning more than nothing in general. We're all trying to beat inflation, right? Keeping our cash into investments so we can try to either match, if not pass inflation, because keeping it straight in cash is probably the worst thing you could do. So yeah, I guess I'll say that for now.
You guys want to hear my totally biased hot take?
Yeah, totally. I'm for it. I'm expecting
Do
a
it.
Bitcoin at least like a few times. I'm ready for it.
Yeah, so you hit it right on the head of the nail. I think the issue with Wealthsimple is, in one word, Bitcoin, where they're just totally ignoring Bitcoin as a great portfolio hedge, right? So, I don't have the numbers ready to prove it or anything, but my hypothesis is that if you were to rerun this calculation, but add 5% Bitcoin into all the Wealthsimple funds, that they will be the best performing out of the three, right? So all you need is 5% Bitcoin into all those portfolios, and then all of a sudden you go from being the worst to the best, and you will beat the market with only 5% Bitcoin, right? So I think you guys are being a little bit too nice to Wealthsimple. I think that Wealthsimple is violating their fiduciary duty to their investors by ignoring Bitcoin and not adding any Bitcoin to their portfolio. So I think if you set your risk tolerance to max, again, I'm not saying that they should add it to every single one. So maybe so for those of you who don't know, Wealthsimple's managed portfolios have a risk score from 1 to 10, with 1 being the most risk averse and 10 being the least risk averse, meaning that they'll put more equities in your portfolio if you go with 10. So if you go with 10, not only do they put, I think 90% equities, they also put 5% gold. So they do use gold as a portfolio hedge. But as we know, gold hasn't been a good portfolio hedge for a long time, right? So I know people who are gold bugs are going to get mad at me for saying that, but look at the data, right? Look at how gold has performed. Sure, it hasn't crashed through the floor, but if you compare it to just any the S&P 500 or anything, gold has performed terribly for the past decades or going back, right? So yeah, I don't think adding 5% gold is working. So what I would like to see with Wealthsimple is for them to add 5% Bitcoin, right? So maybe you can keep the gold in there and do 5% gold, 5% Bitcoin, right? Just to, balance things out and see what works best, and then do 90% equities, and that'll be your growth portfolio, right? And for your balance, maybe do 3% Bitcoin, and then with conservative, do 1% Bitcoin. But at least, put that portfolio hedge to work, because that's what Bitcoin is kind of designed for, in my opinion. And it's just a shame that Wealthsimple's not seeing that. And I think that, if anyone's watching this, Wealthsimple, if you're watching this, or any other fintech company is watching this, and you want to do a managed portfolio, just adding 5%. I'm not saying going all in, right? Because then you just become a Bitcoin ETF, and we already have those. But just put 5% and then just literally wait and see what difference it can make for you and your clients. So that's all I have to say around that. And yeah, any thoughts on my hot take?
I don't think it's a hot take at all. Like, I want to actually defend you. Like, I myself, okay, I'll be honest with you, I'm not as bullish as you two in terms of like Ethereum or Bitcoin or cryptocurrency in general, but I say it's kind of ignorant to not be involved at all. I personally have about 5% of my net portfolio inside of BTC and ETH, and I'll be frank with you, it's actually treating me pretty well. Like, with the small amount that I consistently like dollar cost average, it is actually feeding me rewards that I never actually expected that it would. So long as if you just like put your money like into different sources or like just put it into BTC and ETH, not financial advice, but I think it's recommended, if anything, to just invest into those sources if they are like provided, because why not? Especially like since we're all in our 20s, it's kind of a no-brainer, I think. But I think it's not a bad idea for Wealthsimple to put inside of their like packages or like ETFs, whatever you want to call it too. I think it'll actually do itself numbers. So I agree with Andy.
I think regarding that front, I think also the growth one. I feel like if my risk is at 10, why not throw some Bitcoin in? Like honestly, like there's Bitcoin ETFs. Canada's had them for a long time. Why not just add some to the portfolio? I've my managed section of my in my Wealthsimple. I have the Wealthsimple Invest, and I have it set to 10 10 risk level, and it is still extremely not risky. This thing does not move up quickly. It does not move like the S&P 500 is up humongous amounts, and this thing is up like very small amounts. So it's pretty clear to me that it's not going to be zooming to the moon. And as a growth what's it called, like a growth portfolio, I would expect it to be taking honestly a more risk, because if my risk is at 10 and I'm going, I can handle the 10 risk, you should be taking a bit more risk. And if and Bitcoin represents an area where, you know, you might argue there's more risk, but there's also more rewards. So I think it would be a pretty prudent addition to have it doesn't even need to be 5%, but like some exposure to it in that portfolio, I think would be a benefit to the portfolio in general.
So I guess maybe my hot take, like the maybe part that's like the most controversial, is the following statement, and I'm wondering specifically if you guys would agree with this statement, right? So as I said earlier, the hot take is I think that every finance manager or every money manager is violating their fiduciary duty by allocating 0% to Bitcoin if they're allocating 0% to Bitcoin. So I'm wondering if you guys would agree to that statement.
I think it like I hate to like run around the question, but it just depends on like the target market. Like what if these like would you want to call them like hedge funds or something or whatnot? What if these like hedge fund managers so happen to implicate like Bitcoin into their portfolios, or like let's say these like listed here on the side. Some boomers may not like that because they're not willing to understand. I feel like a certain demographic of people are at the point where they're pretty satisfied with their circumstances, and they're not willing to learn or like develop new skills or like understand new things. So it might not be as open to them. So they might not actually get the demand. So maybe that's like deferring like these people to like not add Bitcoin in it's such. But I think for Wealthsimple, I don't think it's too much of an issue to add like Bitcoin at least like 5% or below, just because I think the vast majority of people who are doing the Wealthsimple fund or this basket of investments tend to be on the younger side. For example, like millennial and like Gen X or just Gen Z. So I think for that, why not? So I guess that's my opinion.
So, on regards to whether or not they're violating their fiduciary responsibility, I think it's difficult to argue that they are violating their fiduciary responsibility, assuming that they don't understand Bitcoin. Because if they don't understand Bitcoin, I think it's really hard to argue that they should be adding something that they don't understand to their portfolio as a major portion of it. And now, I can see you're probably thinking, then they should go understand Bitcoin. Right. But I think that it's difficult to get these people to think outside of the ways that they've been set in, and
Yes.
learning to appreciate the value of Bitcoin is something that doesn't really happen overnight. So I think that it's hard for me to say you're violating your fiduciary responsibility when arguably the fiduciary responsibility is that they should be doing everything in their power to ensure that they're um doing their best to provide you the highest rate of return that they can. And theoretically, they are attempting to do that. And now the way they may be going about it may be flawed in the sense of that they should be learning about Bitcoin and making it a part of their portfolio. But the fact that they aren't doing it because they don't understand it, I think is also like something that can be a good thing, because I don't really want to be sitting there watching my money manager go and dump all my money into some garbage coin that just popped out of nowhere because they've done no research, but they're like, I need to be part of the crypto market. So again, I think that there is like I think that they could be doing better, but I don't think that they are explicitly violating the fiduciary responsibility.
But here's what I have to say to like push back on that, right? I think isn't their job to understand, like that's what you're paying the management fee for, right? Because like you as the customer, you kind of come from if you're assuming using this product, this managed portfolio product, you as a customer are basically saying to them, hey, like you understand financial markets more than I do, so that's why I'm entrusting you with my money, because I think that you will be able to invest better than I can. But if I understand, if I get to the point where like, as a customer, I understand more than the advisor, then maybe like I don't need to give the advisor my money, right? And if I do, then like I'm paying the advisor to understand everything that there is to know about investing, which is why I'm trusting my money to them in the first place.
Well, I don't think that I don't think it's necessarily the same though as understanding the financial markets versus understanding the crypto market, because I know the crypto market is within the financial market, but there's different levels.
Yeah. So
it.
the crypto market is kind of like a new aspect of the financial markets that not a lot of people can understand right away, right? That I get your point on that. However, Bitcoin has been a thing for over 10 years at this point. So it's like, at what point does it become a violation of fiduciary duty if you continue to ignore it, right? So you're saying maybe, okay, it's new, so it's expected that maybe not every financial advisor understands it, but like, do you have a cutoff, right? Like once Bitcoin hits 25 years or 50 years, well, if Bitcoin's 100 years old and there's still companies that are not paying attention to Bitcoin, assuming that Bitcoin is still around 100 years after it was like first issued, then do you think that at that point they will be violating their fiduciary duty? So if that's the case, what's your kind of cutoff?
I don't know if I have a specific cutoff in mind, but I think that like in terms of years, because I don't think the years is what really matters. I think it's the amount of people who have embraced Bitcoin. Like if it's become something that is like a major impact on the world, on the financial markets, more so than it is now. Um, I think that it would be at some point there is like a cutoff point where it becomes violating their fiduciary responsibility by not doing something to
You just think we haven't reached that point
I don't
yet.
think we've reached that point yet. I think that's the big factor.
So I
Adoption needs to go up.
The way I see it is, let me give you an analogy maybe, right? So let's say you bring your car to the mechanic and the mechanic fixes it wrong and your car breaks even more than it did before. And then you go back to the mechanic and you're like, what the hell, dude? Like, what happened? And then the mechanic tells you, hey, your engine type is new and I didn't learn how to fix this type of engine in trade school. So that's why your engine is now even more broken than it was before. Would you find that to be an acceptable answer, right? So I use that analogy because it's kind of like, you know, you're trusting your money with a financial advisor, and then the advisor invests it in such a way that underperforms the market, and you go, hey, what about this new Bitcoin thing that could have potentially helped you? And then your financial advisor tells you, it's like, oh, I never learned that in finance school, so I didn't pay attention to it, so I didn't add any Bitcoin for you, so that's why I underperformed the market, right? So like, do you think that analogy is accurate, or like, what do you have to say to that in general? Dom or Tristan?
I'll go on. Yeah, no, it seems about right. I think it's a little ignorant that like these financial managers aren't learning a thing or two about Bitcoin. Like maybe in the worst case scenario, there'd be an option to have a set portfolio like implicated with Bitcoin, and then like for you to have the option to not have it. Because I know when people try to learn new things, especially at a certain point, like it could be hard for them to make changes. Like I'm pretty adaptable and open to change, but some people aren't. So I think that's the biggest concern. I think this financial system has been the way it is for such a long time. So to see a new sheriff in town is a little tough to handle for some people. But I think looking the other way, if they're like walking down the hallway instead of saying hi, is kind of like also not the move as well. So maybe in the next coming years, before like 2030, hopefully that Bitcoin eventually gets implemented into I guess these portfolios, but it's let's wait and see, I guess. So
And just to jump in there regarding if like the analogy with the mechanic, I don't think it's necessarily directly the same. Sorry about that.
bless you.
I don't think it's directly the same, but there are some similarities because again, like in the example you gave of the mechanic, like theoretically the expectation would be that the mechanic would be doing something afterwards to make up for their mistake. You know, like there's the expectation that the mechanic is going to fix the problem. But like,
Yeah,
I don't think that
expectation that Wealthsimple adds Bitcoin to their portfolio after this, right? But I'm not sure if they're going to, because like, you know, people, you can show them this like performance chart and they go, well, that's just the market. They won't necessarily admit that like, oh, we underperform, we should do better.
But it's like not really the same as if they add it to it though. Like, and there's also like different levels of risk in the sense of like the risk of my car exploding or crashing or something to that effect, you know, on a highway or whatever, is a very high personal risk compared to the risk of missing out on gains from the market. Like one of those is like I could have done a little bit, like I could have done better, but I am not being negatively impacted. Whereas the car one, it's like my options are you're basically worse off across the board, right? You're theoretically at risk, and your vehicle has depreciated in value. Whereas in the other scenario, my car has it, like my investments may not have done this, but they've done like this, which I think is like a lot less of a
Okay,
punishment.
but you can lose money through like investing as well, right? Like it doesn't, even if you invest in the general market, it doesn't always go up. So let's say if you invested in there, I think one of them was actually negative on one of the time spans. So if you go back to the charts, yeah, so Wealthsimple conservative, which is 35% equities on a 3-year basis, the annualized return was actually negative 1.3%. So like it's not like the difference between this and this, it could be could be down as well, right? So I'm saying that, okay, so what if by adding Bitcoin, and again, I don't have the data to back that up, but I think that if they added 5% to the conservative portfolio, it wouldn't have been negative, right? So it could be the difference between a negative outcome and a positive outcome as well, right? And we're also speaking from a nominal basis, which these data that we're showing, it hasn't factored in inflation at all. So if you really want to be technical, maybe we should look at real returns, which is if you back out inflation from the numbers, right? And if you back out inflation from the numbers, I'm pretty sure a lot of these will be negative. Like a lot more of these will be negative than just the 3-year return from the Wealthsimple conservative, right? So yeah.
Right, but regarding the Wealthsimple conservative one, like the people who are going to be investing in that are also not the people who are going to be comfortable looking at Bitcoin in their account and their as a investment going like, yeah, Bitcoin.
That might be true, yeah.
These like, if you're buying conservative, you're very risk adverse, and the volatility of Bitcoin at this stage is still such that these people would see their account down a bunch a day and freak out, and then these people would see their account up a day and freak out. And like, I don't think even in the scenario where Wealthsimple adds Bitcoin to the portfolio in some capacity, I really don't think that it's going to be the conservative one that is going to be one seeing the most benefits, and two having it even in the account in the portfolio.
Yeah, I'm gonna have to agree with
So
Tristan too as well. I think like at most maybe a very small percentage of Bitcoin or Ethereum in the balanced account, and then for the growth account maybe like 5% max. That makes more sense. But for conservative, I think the target market for that area isn't going to be so pro Bitcoin, but those people just don't know and haven't done enough research, I guess. So
I'm like,
I don't know, Andy, go ahead. I have a feeling.
I mean, so I think maybe the only part that we have a little bit of disagreement on is the way that we like view Bitcoin, right? So I view Bitcoin as the safe play, as like sort of the portfolio hedging kind of play. Like, yes, it's volatile, but as I always say, volatility is not the only measure of risk, right? So one other measure of risk is chronic underperformance. So if your fund that you're investing in is always underperforming the general market by multiple percent year over year, year after year, then I think that's the measure of risk as well. So yes, what you said about volatility, it is definitely a risk factor. But I see, so I think you guys see Bitcoin as a growth vector, whereas I see it as a growth vector and a portfolio hedging mechanism. So in a way, I kind of view it from both angles, where I see Bitcoin as both an area of growth that can potentially make you rich. Again, not financial advice. Don't just buy something because you heard it from a podcast. But I really do think that Bitcoin will go up in the long term. But I also think that it could add some stability to your portfolio as well, which is something that is kind of maybe a new concept that not a lot of people have accepted. And maybe that's the part that where we run into some disagreement, right? Where you see, Bitcoin as just like a growth vector, but you don't see it as a portfolio hedge quite just yet. Am I correct in doing that? I don't want to take words out of you guys' mouth.
I think
That's definitely
too,
me.
yeah, I think on that regard, I think the like as a hedge, it's a hedge against inflation for me, but I don't think it's necessarily at the point where I view it as like a portfolio hedge, because I think the volatility factor I think adds too much variance for me to view it as like a full portfolio, like a portfolio hedge. Because until like in the future, when the volatility has come down because there's been higher adoption, I could see what you're saying, where it's like a much safer play. But at this current point, it's a little bit too volatile for that usage. It's more of a growth and like an inflation hedge to me than necessarily like hedging my portfolio itself. I'm sorry, Dom, I think you were going to say something.
Just like a small part. I think I kind of agree with Tristan. I think it'll do a lot in terms of like our personal like financial growth. Like I do invest into it as well. And it is a hedge against inflation, because if the gains gain, they really do gain. It's just I guess the vast majority of audiences, like for example, who are interested in the Wealthsimple conservative, may have heard a few things about Bitcoin and how volatile and like not fully understood of a coin, I guess, or like an industry it is quite yet. That might like defer people from possibly investing. People may not want to go into that route unless they have more information. It may be too early. So yeah, I guess I'll say that.
Trudeau sure encouraged people not to buy Bitcoin. So, you know, if you're on the conservative one and you're listening to the gov, Trudeau said no. Daddy Trudeau said no. That means no.